This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
If it's got negative growth, if it's got small growth, low population counts in the 1 mile and 3 mile, and it has negative county growth, and maybe only your traffic counts, your cars driving in the front are only like 5,000 vehicles per day instead of 10,000 vehicles per day. We have to take a hard look at it. And you kind of mentioned this before too. We do a heavy look at foot traffic data. So when we look at we could look at an Applebee's and we could, how much foot traffic does this Applebee's have compared to the other Applebee's we've looked at?
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. While our business has done very, very well with multifamily, we've added to our business in the way of net lease. Now, similar to multifamily, net lease is a passive real estate investment that can provide great cash flow. The primary difference is that net lease deals typically have minimal to no management responsibilities. They have these corporate or franchise guarantees on the tenant, and you have that depreciation on the real estate if you actually own the real estate as well, which we'll get into here. Now, you also get that monthly cash flow, which makes it very, very predictable. Now, the key, though, to all this is understanding how to select the right asset, the right tenant, and understanding how the lease works. So certainly not a piece of cake. However, our next guest knows all about how to buy, how to acquire, how to manage these types of assets. He has a successful 20-year career as an IT professional, but went on to reinvent himself and reinvent his career in the world of real estate and real estate transactions. Now, he has since moved away from IT and now owns and manages his own properties, including both multifamily and triple net commercial leases as well. Now, additionally, he has served on the board of the Georgia Real Estate Investors Association, but today he helps bring together buyers, sellers, landlords, and tenants as a managing partner of Net Lease Holdings at Greenleaf Management based in Atlanta, where he specializes in multifamily and net lease investments. Now, with all that, I'd like to welcome Andrew Ziffer to the show. Andrew, buddy, thanks for coming on, man.
Thanks for having me. Thanks for the invite.
You bet. Now, guys, if you like what Andrew has to say, you can reach him via the contact page at gogreenleafmanagement.com. Okay, Andrew, go ahead and tell listeners a little bit about your journey.
Oh, well, like many people, my journey started out of college, believe it or not. So I'll try to do it in less than 3 hours. We have about 4 hours. Is that about it, right?
That's right. 4 hours. That's right.
So I'll try to do it in a couple of minutes. But after college, I just had this I got an engineering degree from the University of Florida. So go Gators, for whatever that's worth to your listeners. I graduated. I got out of college. I got a job at an engineering firm. And I just had this idea in my head that I wanted to be in the real estate business. And so I said, hey, I could buy a duplex. So I literally bought a duplex. I rented out half and lived in half. I paid $120,000 for it. I rented it out the other side for $600 a month, and the mortgage was $1,000 a month. And so effectively, I was paying $400 a month to live in a 3-bedroom, 2-bath, 2-car garage, half of a duplex. I thought that was the best thing in the world, and that's how I started everything. And then, not that I got distracted, but I kind of focused on IT for a long time, and then I moved to Atlanta. And in 2003, I decided to, hey, this IT thing. I rode the internet internet craziness. I was delivering the first internet banking software around the world. I spent some time in Australia, the UK, Belgium, and my wife and I lived in Amsterdam for a year and a half, and that was fun. So we were delivering internet banking software. So, literally I am an IT guy who went to the real estate business. IT had its little bump in around 2000. And so I went to my wife and said, Janet, I want to go buy an apartment complex and go do real estate now. And she said, okay, sure, you can do that. And, with a little bit of hesitation, we did it. And so I bought a 40-unit apartment complex, and I was a full-blown landlord, dealing with a C-grade apartment complex with C-grade customers or C-grade apartment customers. It was not sexy, nothing sexy about it. I evicted half the apartment complex when I got there. I was dealing with drug dealers, people who didn't pay rent. It was interesting. It was basically a very big change. You imagine going from a sterile sort of corporate environment where you have your biggest decision of the day was where you're going to go to lunch, to like having to deal with getting people to pay rent, cleaning up just garbage from the parking lot, detrashing apartments. And so I did that for a while. I bought my first apartment in 2003, bought my second one in 2008. And then in 2017, I exited both of them in 2017, for which was the highest price ever per unit of apartment complexes in Marietta, Georgia for the C-grade asset. So it was roughly $65,000 a unit, which was a great profit. I made some money, and then and that's how I got into the net lease business. I traded in the apartments for literally an Applebee's and a Zaxby's, and I went from I sold my job too, and I bought the Applebee's and the Zaxby's were my full time. That was my those were my paychecks, and there was no more job because there's nothing to do. Basically, just make sure your mortgage is paid and your rent is collected, and file your taxes every year. So for a year, from 2017 to 2018, I like to tell people that I went grocery shopping and folded the laundry for a year, but I was too young to do that for a long period of time, and so Josh and Dave at Greenleaf came to me and said, "Hey, Andrew, we want you to create a net lease business at Greenleaf." And so here we are now, 4 years later, almost 20 purchases later. We've purchased about 20 net lease and retail properties and single tenant properties. We've created a pretty good business here at Greenleaf, and we syndicate our deals. And so we raise money $25,000 at a time. And we're buying brands now such as Zaxby's, Applebee's, Dollar Generals, Family Dollars. We bought a Taco John's. We even have a restaurant and bar in downtown Atlanta. And so that's our business now, and that's what I do now. I primarily buy single tenant, major branded retail properties for Greenleaf, and I run the retail business here.
Nice. So for those people that aren't totally familiar, you've already thrown out a few of the brands. Maybe can you describe what net lease or what a single tenant? I'm assuming these are all single tenant too, right? Single tenant net lease.
These are all single tenant too, and there's the triple net lease, the double net lease. So first of all, like a triple net lease is the easiest possible deal you can ever buy because the tenant is responsible for paying the insurance, doing all maintenance, paying the taxes. So literally all you're responsible for is collecting the rent and paying the mortgage. There's no job, so it's a very easy property to own. Your tenant is not John Smith down the side of the road. Your tenant is a major corporation with a large balance sheet who, if they're just going to pay rent every month, they just do it because it's a corporation who's operating a business out of there, and it's a whole different sort of operation. So, like for example, would you want to have John Smith down the street as your tenant, or would you rather have Dollar General, $1 billion business, be your customer? Obviously, no, you pick. Which one would you prefer?
Right. Well, yeah. I mean, I already go after the multi-billion-dollar company to back up that lease, right? Yeah. I mean, that's the thing. I mean, it's just to your point, you're able to basically fold laundry and stay home because you weren't really concerned about the overall risk of managing the asset, right? You're still able to pull in some steady income and be okay knowing that Applebee's is going to be there It's and those are QSRs that you were buying, but same thing though, right? Those, if you have a long enough lease, there's no responsibility. On triple net anyway.
Yeah.
And double net's a little different, but even that, it's for the most part still fairly easy to manage,
right.
Even on a double net too.
Well, like our Dollar Generals, they're called double net deals. They give us some responsibility. We're responsible for making sure the roof is in the exterior structure is in good repair, and like we have to pay to mow the lawns around our Dollar Generals every month, but then Dollar General reimburses us for it. So there's a little more work with some properties, but essentially it's not the management footprint of the retail business at Greenleaf is very small. We are more so asset managers for these net lease properties than property managers. Like when you get into apartments and these self-storage properties and mobile home parks, those are heavy duty management, as I'm assuming you know. You got to hire full-time staff just to sit there and answer questions all day. But for an Applebee's or a Dollar General, you might answer a couple of calls, maybe one call every 2 or 3 months about something, or something gets lost, or there's some clarification about something. But it's a very easy management footprint. And I just like it. That's what I do now. So that my paycheck is all from these type of very easily managed deals.
Hey, Augustino here, and I would love to connect directly with you. Text the word books to 844-428-1344 to receive weekly book recommendations from me.
Now, okay, so let's play devil's advocate here. So all those lack of hassles must come at a cost. So what are some of the cons that you find that you often have to address? You guys are syndicating these deals, so I'm sure I'm not going to be the first one to ask you this. What are some of the cons that you get on these types of deals when you're trying to pitch them or talking to people about them?
Well, this is a con. It's not necessarily, this is part of our purchase process. But number one, it's an all or nothing deal. So if the Applebee's is there, and things are just amazing and going really well. Applebee's decides at the end of their lease term they don't want to renew their lease. That's a major event, and it's a lot harder to lease an Applebee's out to somebody else than to keep Applebee's there. And so typically one of the cons is that your vacancy, if you have to switch tenants, that usually takes a while. So it could take 6 months to a year to get a new tenant, and you'd have to boost some capital improvement. But then honestly, we went through this with a restaurant downtown in Edgewood, although it's not a major branded restaurant. We had about almost a year of a vacancy in this place. We had to get it fixed up for the new tenant, but then we went from $12,000 a month rent to $16,000 a month rent. So we did pretty well on that, but it just takes some work and it takes more capital. So it's a little bit more capital intensive when you have to change tenants. But if you're doing your work properly at the start, you're buying locations that have very little risk of going through a re-tenant process. And then, also it's not necessarily a risk, but these are more so, we call these study Eddie deals. They're not going to have the variability of rental income. So like, on an apartment complex, one apartment could rent for $1,000 a month this month, and then the same apartment next month might rent for $1,200 a month or $900 a month. With the net leases, it's the rent is dictated in a lease, sometimes almost for 20 years. So for 20 years, you know your cash flow on this net lease investment, and you know your rate of return on it. So it's more predictable and easier to establish what you're going to make off the property.
Right. It's a risk-adjusted return, too. I think that's probably the one of the big things that people have to begin to understand when they try to draw the comparison. We talked about this in the green room for a second. They often try to draw the comparison between multifamily and net lease, and it's like, well, they don't really compare in the sense that they're two different assets, they're apples and oranges. They're both real estate, but they just operate two different ways, right? That's probably the hardest part for many people to grasp. I feel
well,
like.
When you say real estate it's a very overloaded term. Like silly little side note, but I'm getting my broker's license right now, and even on the brokerage test, they teach you about how you're never an industrial expert and a multifamily expert and a net lease expert and a mobile home expert. You pick one real estate silo, and then you become the expert in that little silo, and that's what you do. You can't be an expert in all of them. You can maybe have a lot of expertise in a few of them, but typically you're doing one or two of them really well, and the other ones you just, you're not involved in.
That's right. No, I totally agree. It's, I find, at least for the guests that we've had on the show, they're strong multifamily people, or they're strong net lease people, they're strong developers. I've yet to find someone that is an absolute monster in everything that they do, right?
And when you do find that person, make sure you ask them more questions, because they're probably not telling you the truth.
Right. Well, we don't have them on. We just don't have those guys on. It's simple as that. That's how we do it. We just don't have them on. So when it comes to that thing that you mentioned before about the risk involved, right? About finding the right location, about picking the right tenant. How do you mitigate some of those things? I mean, I know that there's tools out there to say, for data analytics to figure out if a location is popular using cell phone data. Some people like it, some people don't. I think you guys might use something like that, right?
Oh yeah, we are, our decisions. Although I always say this, buying real estate is an art. Buying real estate is not for the faint of heart. It is an art form, but we try to drive all of our decisions with data. So when we have a property come in that we're looking at, we literally have a scoring a system for that property. So we have a gigantic spreadsheet with all sorts of metrics. We put the Dollar General in that we're looking at. What kind of front street traffic does it have? Does it have a right turn? Does it have a left turn? Is it an out parcel to a strip mall? What's the population growth of the 1 mile radius, the 3 mile radius? What's the population growth of the county? And so we literally score all of these. And then more importantly, like if we've scored, say, 50 or 40 Zaxby's, we then could take those 40 Zaxby's and rank them compared to each other. And we say, okay, well, this Zaxby's that we're looking at right now is like one of the top 4 Zaxby's we've ever looked at data-wise. But or this time it's actually maybe 39th. And so if it's top 4 or 5, we have to take a hard look at it. But if it's got negative growth, if it's got small growth, some low population counts in the 1 mile and 3 mile, and it has negative county growth, and maybe only your traffic counts, your cars driving in the front are only like 5,000 vehicles per day instead of 10,000 vehicles per day, we have to take a hard look at it. And you kind of mentioned this before too. We do a heavy look at foot traffic data. So when we we could look at an Applebee's and we could, how much foot traffic does this Applebee's have compared to the other Applebee's we've looked at? So first of all, if we're looking at a deal, we know it's already passed some basic metrics, and so then we put it in our scoring model. And so all of these Applebee's in our scoring model, then we can compare them to each other. And so that's how we're kind of making our decisions based on data. And we tend to pay attention to the top half of the foot traffic. So if something falls in the bottom half of foot traffic for like the 50 mile radius or the state or the US, we don't necessarily pay attention to it. But if it's above 50%, the 50th percentile in foot traffic, then we pay attention to it. Interesting.
So, I mean, how do you figure that out then? So you guys, I'm assuming using Placer, right?
No,
Placer AI.
Can't tell our secrets, but maybe. And we're paying a lot of money for that data too. So
Oh sure, yeah, it's not cheap.
Yeah,
No, we know. I know it's not cheap.
Yeah.
But it sounds to me then that it's kind of because we're working on developing models like this as well, where we're looking at assets, even if we have no intention of buying them, we're still analyzing them anyway, using some data techniques to basically pull in from all these different data sources and sort of somehow rank things up to determine the strength of a local market itself at large. A little more complicated, but we have some smart folks on the team that really know how to do that stuff, which we're very lucky that we know how to do that. But I think if understanding the strength of a local market will certainly tell you how that asset that you're targeting is going to perform too, right? So it sounds to me like you're doing something along those lines as well.
Yeah, which is great. And sometimes, not all times, we get sales data. So like for some of our QSR restaurants, they'll give us sales data, and then we know that we can go to Restaurant Business Online and say, okay, what is the average DQ, for example? We own a DQ. DQ Grill and Chill. What does the average DQ Grill and Chill earn in a year? Okay, and then our DQ earns this much. Are we above the average or below the average? And so we do those metrics too. And sometimes sales, we would say, trumps foot traffic data, because sometimes foot traffic data lies, because there's, there's just like anything, there's problems with foot traffic data.
Sure.
And like drive-throughs are particularly hard. So foot traffic data for QSRs is really hard, because what do you do for drive-throughs? How do you measure that? You have to, a lot of times the services, they say, okay, if this GPS signal is in this location for, say, 7 minutes, I'll say that's a hit. But what if the person's going through a drive-through and they're in and out of there in 4 minutes? Will the foot traffic even be logged? And it won't. So, the foot traffic services tell us that, it's hard for it to work for businesses with heavy drive-throughs.
Yes. Now, here's something interesting. The other day, I had a phone call from someone that was looking at buying their own store, I think it was a Dollar General or Dollar Tree or something like that. So rather than investing we have a fund, right? Rather than investing in a fund or investing with an experienced syndicator like you, they want to try to go buy something on their own. And I often say that, we're looking at 1,000 deals before we find one or two that might be okay. We're looking at a lot of deals. I'm assuming you guys do the same sort of thing.
Well, yeah, we're looking at hundreds of deals a week, and literally, like even our scoring model, we're probably on like the properties that have passed the initial test. We've probably looked at 3,000 properties inside of a scoring model, so we could literally rank these 3,000 properties against each other.
I want to take a pause from today's show to share something that I've been encountering. As I speak to many investors, there's this concern, and the concern is centered around the inflation we've been experiencing and the devaluation of our currency. Now, we've seen some of the highest inflationary periods over the past 30 years. That's up over 8%. Economists actually believe that inflation is closer to 20%. Some say it's even more. Now, what does this mean for you? Well, it means that money that is sitting in your bank account or self-directed IRA that's not invested in physical assets that hedge against inflation are losing buying power. That means that every minute, every second, that dollar is becoming less valuable. You see this every day. You see this in the groceries you buy, the gasoline you buy, everyday items that you're buying on a daily basis are becoming more and more expensive, and you're using a less powerful dollar to buy these items. Meaning that dollar is losing value if it isn't put into a property that produces cash flow, just like real estate does. Now, our team here at Bulletproof Cashflow has put together a series of weekly webinars that cover real estate investing like multifamily, net lease, and real estate development. Now, these are purely educational webinars. In these webinars, we talk about why real estate offers a powerful opportunity right now and why it makes sense to invest in these assets today. So if you're interested in real estate or want to have the opportunity to get involved as a hedge against inflation yourself, I encourage you to go to bulletproofcashflow.com/webinars. That's bulletproofcashflow.com/webinars. Now you go there, these webinars are 45 minutes and they cover different topics every week. We go over the things you need to know to avoid some of the common pitfalls when it comes to investing while getting you prepared to invest your paper dollars into a real physical asset. Now, if you can't make the webinars, just go ahead and register and we will send you a recording that you can watch at any time. And by the way, these webinars are entirely free. There's no cost to you. This is just something that we do to educate our folks out there. So if you're enjoying this episode, please like and subscribe to Bulletproof Cashflow. It helps the channel tremendously when you do. Now let's go ahead and get back to the show. Yeah. So, but it sounds to me then, like you said earlier, this is not for the faint of heart. This is not an easy thing anybody can just do. You're almost better off, in my opinion, partnering up with someone that has the data, the skills, the knowledge, and knows how to buy this stuff, because it's not an easy thing, right?
Yeah. You know what's been happening recently, which is not necessarily a shift, but we have people coming to us and saying, "Hey, I'm selling this property. I don't have time to do something else. It's $1 million. Can you put me in one of your deals?" And we're putting these people who are trading their deals and doing 1031 is a whole different conversation. You could how much you want to get into that, but they're giving us their 1031 proceeds because they don't want to pay taxes on it, and then they're investing in one of our deals to defer the taxes and just trust us to manage it. And then by default, they're out of the management game too, because then it's Greenleaf's responsibility to manage the deal. And actually, who's going to be able to underwrite the deal better? A Greenleaf company who has like a team looking at these properties and analyzing them and doing the due diligence, or some guy who's got some money from somebody he made from and wants to go buy a piece of real estate, who's, maybe he's bought 2 or 3 pieces of real estate in his life and he wants to go buy a Dollar General. Who's going to buy that Dollar General better? Not that I'm perfect. And, we always make mistakes. And, first thing I'll say is, knock on wood, things have gone well. But, there's always market factors. In fact, right now we're going through an awesome market factor, which will tell the tales of, the kind of decisions we made. Because if we made good decisions a year ago and 2 years ago for the stuff we own now, we're going to weather the storm really well. And so far, Greenleaf is weathering the storm pretty well. In fact, we're selling assets, we're still making money, and we're still able to buy. But we're not able to buy at the volume we used to buy at, but we're still buying good deals.
Yeah. Well, and it's interesting. So, what do you think the market holds? I mean, I think towards the beginning of the year, it was tough to find deals that fit our criteria. Anyway, we're trying to find slightly higher cap deals these days. Certainly, the lending has put a damper on trading between buyers and sellers, but they're still happening, and cap rates have let up a little bit. What do you think the market? What do you think? Not really the market. What do you think the future holds, I guess, for the next 24 months, 36 months in terms of net lease?
Well, I went to a 5K race one of our bankers helped sponsor recently in Atlanta, and he basically told us that his boss, he's the lender, his boss at his firm told him, yeah, let's just kind of take a break for a few months. And so literally this bank is doing nothing, doing no lending for the next few months. And so that was kind of interesting. But things are going to slow down. Things are slowing down for Greenleaf right now. I mean, the deals are fewer and far between. We have to buy deals that are not interest rate dependent. And so not interest rate dependent means you have to fix a problem. So you have to fix a short lease. You've got to fix a capital problem. The cash flow deals are not there anymore, because when you're buying at, say, a 7 cap and you're lending and you're getting lent money at a 6 cap, it just doesn't work. We used to buy deals at a 7 cap and get debt at 3.5%. And so when you have that spread between cap and debt, you do a lot better. But that spread's no longer there. And as far as where things are going, all the talking heads that I pay attention to, 2022, end of 2022, well, things will be slow. Beginning of 2023 will be slow. And then, hopefully during the summer and the fall, we're starting to show signs of recovery, interest rates letting up, inflation going down. And, my hope is that things return to somewhat normal in the middle of next year and we return to like a normal volume.
Yeah, I hope so too. Because we're trying to buy stuff as well. And yeah, it's tough.
Have you been able to buy anything recently, or is your like?
Yeah. No, we're still buying. We have like 3 deals we're closing, hopefully in the next 30 days or so. So we're finding stuff. But yes, I mean, it took a while. And your debt is making you nauseous, I'm assuming, for the interest rate that you're paying. That makes us very nauseous. I think that also deal size plays a big role in things, because how do I say this nicely? The larger the deal, the more sophisticated the seller. So the smaller the deal, they're not really that sophisticated. So sometimes dealing with some of the nuances of a less sophisticated person tends to add time to deal closing, right? As you know, I'm sure. So that's probably one of the biggest hassles is dealing with some of those scenarios, because we're buying deals at all different size, all different areas, mostly conservative states, just because they're easier. There's some sort of stability there, I guess, for lack of a better term. So yeah, I mean, that's how we're doing it. But yes, it's certainly a challenge these days. Certainly a challenge, But that's all right. We're going to get it done. We always do.
Yeah, and your deal volume always changes. Your deal volume 1 month is crazy, and then your deal volume for the next 2 months could be dead. But it's all cyclical. Yeah. It's all opportunistic, and it's all, and it's back to that whole art form of, how can I make sense of this piece of real estate, and how can I make money with this plan? And hopefully you see something that other people don't, and your plan works is the bottom line.
That's right. One question that I was talking to a buddy of mine that also does net lease, and he and I were listening to some show or something, and someone mentioned a trophy asset, a net lease trophy asset, and he scoffed. He goes, "What difference does it make if it's a Starbucks or a Dollar Tree? The return is the same." Meaning if the money's coming in and the money's comparable, what difference does it make what it is? What are your general thoughts about trophy assets? Because I think most people, they think of trophy asset, they think of like a multifamily asset, or they think of some sort of like a ballpark, not really net lease. So what do you think about that?
Well, I think it's fun to say that, it's fun to say that I own a DQ Grill and Chill. It's fun to say I own a Zaxby's or a Panera. But, at the end of the day, it's a business, it's a paycheck. But I will say, sometimes trophy asset could be equivalent to saying it's a good brand. Like, are we buying a, oh my God, remember Burger Chef? Do you remember Burger Chef?
Burger Chef in the South, right? They're in the South. Yeah.
It was in the South. Yeah. Burger Chef is no longer around. We had this whole conversation about Burger Chef. And so maybe there's, one Burger Chef or two Burger Chefs someplace around here. I don't think I would want to brag about that too much. But, on the other hand, if I owned a McDonald's or a Burger King, I wouldn't want to brag about that either, because if I owned a McDonald's or a Burger King, if I just owned the real estate, the rate of return on that McDonald's or Burger King, I would have paid so much for it that my rate of return would be very low. It would just be more of a place to park cash. And, would I want to brag about McDonald's or a Burger King if I was not making money off of it? So, I think it's back to, if someone wants to brag about a trophy asset, you're bragging about, you're making money. It's a solid brand. You believe in it. They don't, they're not using child labor in Indonesia to do something. Right.
I think that's my buddy's point, is that, what's the point of owning McDonald's, Burger King, Starbucks if you're buying it at a 4 cap and the cost of debt is almost 7? You're losing money.
Oh my God! When the 4 cap deal started coming in, it hurts. Like it hurt. Yeah. And so somebody thinks it's really sexy to buy a 4 cap Starbucks. It's like, okay, well, no, more the power. Chick-fil-A's. Are Chick-fil-A's in Ohio? Have they made it there yet?
There's some here. Yeah.
Okay, because Chick-fil-A's in the Southeast, they trade at like really, really crazy low cap rates, and it's just you get to brag about how you own a Chick-fil-A and you bought it at a 4.5 cap.
No, I don't care.
Yes.
We prioritize investor returns. I don't really care what it is. If it's publicly traded, if there's a strong franchisee backing it up, I'm fine with it. Don't care,
I'll brag about my Zaxby's because I love Zaxby's. I love the eating there. I love the operator. I love the brand. We make good money off of it. And, I'll call that a trophy asset because it just checks all the boxes and we love it. And personally, I just love the brand. My wife doesn't like it very much, but that's because, she eats a little bit better than me. But, that's a whole other story.
That's right. Well, I think you run marathons, you said, right?
I run a lot. So whenever I eat a Zaxby's, I get to run off the next day. My wife does not run off Zaxby's the next day. So yes.
There we go. So you get to do all that. One thing I wanted to touch on before we move on is, I know you touched on the locating of assets and I guess the underwriting of the physical asset itself in relation to the location and such. What sort of things are you looking for on the financials? Because typically, because they are so consistent, to your point, it's like, that the lease says they're going to get paid X every month and you get paid X every month. There might be a few maintenance expenses here and there, but it's usually fairly stable. But when you're evaluating the financials, are there any pitfalls you're looking for? Are there any things that you're trying to find that would tip you off that something may be amiss?
Well, number one, whenever we have a lot of brands we've already done a lot of research on. So, like for example, when we have a new brand, we start to look at. We've done tons of research on Dollar General. We know Dollar General upside down right now. But like we had a new barbecue, like a 60-unit barbecue place come across our desk, and we looked at that. And so we had to do a deep dive into it. And if you want to laugh, the first thing we do is we go to the good old internet. And how is this brand doing? What's the news about it? Have they filed any bankruptcies? Have they had any lawsuits? Have they had any salmonella poisonings at their like what is the news about this brand? And we had one brand there's one we looked at recently that had a bankruptcy like 3 or 4 years ago, but they're also turned around right now and they're going through a great turnaround. So if it had a bankruptcy 4 years ago and they've gone through and they've had a new CEO and they have new management, and they have a trajectory upwards now, do we still consider that brand? So, we look at the news financially, if it's a public company, we could look at, how much cash are they burning through? What's their average store earning? Is their gross revenue increasing every year? How is their balance sheet? Like what kind of cash do they have on their books? Is the cash on their books getting higher or staying the same every year, or are they burning through cash and their cash in the bank is going down every year? Who are their sponsors? Like, for example, Goldman Sachs. Goldman Sachs just had this partnership with Zaxby's now, and they bought a big part of Zaxby's. And so if Goldman Sachs is investing in Zaxby's, would you want to buy a Zaxby's?
Sure, of course. They do their research.
Yeah. Who's going to do more research, Goldman Sachs or Greenleaf? And I can tell you right now, Goldman Sachs did a lot more research on Zaxby's than Greenleaf could ever do on Zaxby's. So,
right, that's right.
And
that's right.
So, typically look at whatever public information is available. And then, we have some private information that we get sometimes, like we get store sales, we'll get operator sales where we're buying one location that's a franchisee of about 100 units. And they're going to give us their financials of, okay, what does their 100-unit portfolio look like? How does it cash flow? And we get to make a judgment call of, okay, is this good enough? Is their top-line revenue going up every year? Is their top-line revenue going down every year? And so we have to look at their portfolio as a whole, too, to see, what is their trajectory? What direction are you heading? Are you heading in a good direction, or are you heading in a not-so-great direction?
Yes. I mean, that's ultimately what it is. And I actually made a decision just recently. We don't usually buy banks. I don't think you guys don't really.
I can't get my hands on a bank. Yeah, so we haven't bought banks before. In fact, our banker had our main banker had one of his branches come up for sale, and I turned it down. And it was his bank.
Yeah, and the funny thing is that many lenders, many banks they're moving more towards the whole online scenario. They don't want to have the expense of the overhead of the real estate and everything else like that, or making those lease payments. Why? It's just everything's in the palm of your hand.
Here's the question for you: when's the last time you were in a bank?
Well, I go to the bank. I just did a wire the other day. So
but you will go. You go in the bank for the wire?
I had to, yeah. I had to.
I see the wire. We did,
but I wouldn't have done it if I could do it on home. So it exceeded the amount that I was able to do online. That's the only reason.
Okay, but if it was a smaller wire, you probably could have done it at your desk. I'm assuming.
For sure. Yeah, for sure. For sure.
But yeah, so you went in the bank. Okay, when's the last time before that you went in the bank, though? I mean, I'm assuming you don't go in the bank very often.
No, once a month, maybe. Yeah, it's a pain. It's a whole thing. Because nobody wants to go there. Yeah,
and honestly, I think banking is it's becoming a not that I'm going to say I'm young, but it's for a lot of seniors, I think, because the seniors are just sort of used to that whole experience of going into the bank, touching and feeling something, cashing a check, giving their grandson, or granddaughter like $2 bills. There's that kind of fun stuff too.
Yeah. That's the thing that we used to do when our parents took us there. Right, a long time ago. Well, but the thing is, though, is that what we did was there's 4 banks in the local area. We went to, it happens to be here in Ohio. We go to the property and we see that the asphalt's all messed up. It's triple net, by the way. Asphalt's all messed up, which is unfortunately normal for Ohio because it gets really cold here. Snow, it gets beat up a lot. But one thing we did was we looked at the FDIC deposits. So they wouldn't necessarily tell us how many customers they have or whatever, but they could. FDIC deposits, you could see that. And we saw that they were just 4 stores. They're number 3. And the 4th one is like way far behind. The first 2 are brand new. The first 2 stores, number 1 and number 2, are both brand new stores, right? So we opted not to pursue that deal, obviously. But yeah, I mean, there's a lot of data out there aside from asking the location for their information, which they don't usually like to do for whatever reason.
Yeah, there's a bank around the corner from me right now that turned into a dry cleaner, and now it's about to it's going to be a Chipotle. So if you want to invest in a Chipotle, they used to be a bank. Talk about that.
There we go. Yeah. Hey, listen, I would hate to hang on to that property, especially the amount of money they're asking for that thing. It's a huge piece of land. I think it's probably just about an acre of land. And if you get stuck with it, because they bolt after 2 years or whatever, then you're stuck with the taxes, you're stuck with the insurance, you're stuck with everything that associated with that asset.
Banks are a whole different thing. I don't understand, because they're all small governments, and I hate saying this, but they're all, manipulated in some form, like how banks make money. It's just okay, what legally can we do? What are the rules about this? Do we have to keep this branch open because of this? And if you want to laugh, in my neighborhood, there was a Wachovia and a Wells Fargo. And then, of course, they merged at some point in time. And so then what happened? There was a Wells Fargo, and 3 doors down, there was another Wells Fargo. And that existed for, I think, 5 or 10 years. Because what happened is Wells Fargo did not want to close one of the branches because they did not want another bank to go into that location. So finally, they waved the white flag, and they closed that second Wells Fargo 4 doors down from the other Wells Fargo. And you know what that old Wells Fargo is right now?
What?
It's a COVID testing site. The parking lot is a COVID testing site.
Sponsored by Wells Fargo.
Yeah. And the poor people don't even get to use the bathroom inside the Wells Fargo. There's a porta potty outside at the COVID testing facility. So I thought that was kind of humorous.
Yeah. But that's an interesting thing, though. Well, I mean, I don't even want to get started with how banks manipulate dollars and how they multiply dollars 9 times just to maximize their inventory. But I'm not going to get into that. That's a whole other podcast. That's a whole other show.
Yeah.
Well, we covered a lot of stuff here today when it comes to Net Lease. What sort of bulletproof advice would you have to offer for someone listening right now?
Bulletproof advice. I would say it's really important to understand what you're doing, and to also understand that a lot of times you don't understand what you're doing. And it's good to talk to people like you or me who, have done this once or twice before you do something. Because a lot of times, you could do more in partnership with someone else than something on your own. So it's really good to kind of partner with experienced businesses, experienced people who know what they're doing. And, it prevents you from getting taken advantage of. In fact, I will say this, my first deal, my first apartment complex, I fell hook, line, and sinker, and I was taken advantage of for a very major purchase. And it took me probably a year to bury myself out of it. But I took myself out of it. I did great. I sold it, But, it took me some time to figure that out. But, if I took that same money and invested it with somebody who was a professional operator or knew how to do this, maybe my trajectory would have been a little bit different, would have been 5 years ahead or 10 years ahead of where I'm at right now. Who knows? Bottom line, You never know. But I would say working with experienced people is probably the best decision you could ever make.
Oh, 100%. Hey, there's nothing wrong with investing with a strong syndication and learn from them how the sausage is made. Nothing wrong with that at all. I think to your point, it's a far better experience for the investor to sit down, and they didn't have to sit down with you, talk to you for 20 minutes, 15 minutes about how you're selecting deals. Oh, okay, great. They're vested in the deal. They understand how you're putting it together and what your criteria is. It gives them a sense of, now I understand how this works. Do I really, really want to sit here and do what Andrew does all day? Probably not,
Yeah. And the other thing is integrity too, invest with people with integrity, because I will say that, my friends and family have trusted me with a lot, and I take that responsibility really seriously. So if you're investing with somebody that, doesn't feel right, or, you just feel like something's not right, don't do it. Trust your gut. Invest with people you trust, who you think have integrity, and that, have somewhat of a track record of making sure that, they can do this again. They've done it for themselves, and they can do it again for you.
That's right. Love it. All right, guys. Well, if you want to reach out to Andrew, you can reach him via his website at gogreenleafmanagement.com. Hope you got some insight on how Net Lease works. Thanks for tuning in, and I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, head up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.